All right, welcome back to the program. In case you're just joining us, as you can see on the screen, COVID-19 Watch. This is where we keep you up to speed with the economics of the pandemic. Moneyline with Nancy. Joining me right now is Charlie Robertson, who is the global chief economist at Renaissance Capital. Hello, Charlie. Good morning to you from Abuja.
Good morning to you. Very nice to see you, and thank you for inviting me onto the show.
Thank you very much for joining us. Now, Charlie, I think I need to start by asking you this question that COVID-19 is testing Africa's economic resilience. It's testing us in every way possible, both socially, economically, politically. It's also testing us. How much will Africa lose with this pandemic? How much do you think we will lose?
Well, I think one advantage first is that the loss of life is going to be less in most of sub-Sahara than it would be anywhere else in the world because of the young population. The average age of people dying in the UK is 80 years old. And the average age, I think, in Nigeria is 19 years old. So there's so many fewer older people, which makes sub-Sahara much less vulnerable to the virus itself. But the economic impact is terrible. So the oil price collapse that we've seen, I think is going to be very painful for Nigeria. We're seeing already in inflation. It's causing concerns about debt profiles in countries like Angola. So the economic hit is going to be strong and powerful and negative. But hopefully we get something of a decent bounce back next year.
Okay, let's take a look at the responses, the economic responses so far by African countries. You're seeing different monetary policies. You're seeing that most central banks in Africa have cut their interest rates. They've also brought out stimulus packages. I think just about 3-4 days ago, Kenya did announce another $500 million in economic response to battle the pandemic that will go to the tourism sector, horticulture, and all of that. How do you think that we're fared in terms of our monetary policy and fiscal policy in a bid to fight the pandemic?
Well, the oil exporters haven't had the same ability to do what Kenya, which is an oil importer, has been able to do. So Kenya's saving money right now because of the fall in the oil price, which is making life a little easier for them.
Okay.
I'm not seeing.
Okay, Charlie. I think let's quickly take a break. I will need you to adjust your camera so that we can see you very well. So that we can get a good shot of you. Let's quickly take this break to do that. Then we'll be right back to you. I'm being joined by Charlie Robertson, who is the global chief economist at Renaissance Capital. Let's quickly take this break. We'll be right back.
That COVID-19 can be characterized as a pandemic.
This is where we give you the economics of the pandemic.
The nature of this pandemic has very significant impact on public health. No one person, no one individual, no one company can basically rise up against this pandemic.
We even started weathering the storm economically. So many challenges for Africa at this time. How quickly are we going to see businesses adapt?
All countries can still change the course of this pandemic.
We must interrogate ourselves after this and say, what lessons have we learned about our healthcare system?
The scale of this is huge. You've created several new layers of unemployment through the lockdown.
So there are multiple dimensions of this problem that it requires bold and creative steps in order to resolve. If we need to have a homegrown solution.
It's about lives and livelihoods. How do we deal with all of that? All right, welcome back. Charlie Robertson is still with me. He's the global chief economist at Renaissance Capital. Hello, Charlie, you still there? Can I see your face now? Okay. Charlie, you know what you're going to do for me? I need you to shift back a bit so that we can get... Yes, just shift back a bit so that we can get your full shot. I want your whole face to be on the screen so that we don't get to cut you.
You don't get to see my lines so much.
Yes, so I don't get to see your fine lines. so much. Okay, good, good. That's a better shot. Okay, Charlie, I was asking you earlier about the monetary response as well as the fiscal response from different African countries. So land on that point.
So the problem for Nigeria is that its revenues have anyway been very low. The government's not been taking a lot of taxes. Anyway, when the oil price collapses, you suddenly you're in an even more difficult position, and also the currency is under pressure. So Angola's currency is weaker than 500 to the dollar now, and there's a lot to be suggesting in the data that the Nigeria's currency should also be weaker. So there's a lot of risk of depreciation, and that means inflation could come through, and that means the central banks then have to try and keep rates quite high. So Nigeria is not in the same place. It doesn't have the same advantages that an oil importing country has.
Okay, since you've brought me to the issue of currencies, let's stick there a bit. What do you think is affecting African currencies the more? Is it the pandemic? Are they feeling the pandemic pain? Does the currencies feeling the pandemic pain more? Or is it about commodity prices being downside at this point? What do you think, from the Angolan kwanza to the Nigerian naira to the Egyptian pound, which was at a time better appreciated against the dollar, but a lot of analysts say that is a bit overvalued. Then the Ghanaian cedi, on the other hand, was, I think, sometime ago in mid-February, the best performing, or the second best performing currency in Africa. So analyze for me African currencies. What is hitting them right now?
You're absolutely right. It's the commodity shock which is hurting the most, and we've seen a lot of pressure for the oil exporting nations on the currencies. For Ghana, we think it's a very cheap currency, and Ghana sells products like cocoa, which people still consume even in a recession, and gold, which has proven quite popular for investors in the last couple of months. What's not popular at all is oil, and as a result, the currencies have to depreciate. Egypt has held its currency strong, but it's gonna sign up to an IMF program, not just a bit of cash like the $2.8 billion Nigeria got, but maybe a one-year standby arrangement where there's loans and the IMF is making good recommendations on policy. And that should stand Egypt in good stead. Kenya may well do the same. But so far, Nigeria just wants to take the 2.8 billion, and it is not clear that Nigeria is going to do a bigger loan and an arrangement where the IMF is also giving advice.
Okay, which African currency do you think will show resilience the more, despite the dislocation that we're seeing right now due to the pain of the pandemic? Which African currency will rise, will show more resilience?
The easiest one to say is South Africa, but it's not because it's an African currency. It's because it's seen as the main emerging market property. If you want to invest in emerging markets, you buy the rand. If you're scared of emerging markets, you sell the rand. And a month or two ago, the rand sold off to among the cheapest levels it's been in 25 years. It's now rallied back quite strongly in the last month. And I still think there's a little bit further to go. Short term, I'm slightly worried about a US-China trade war that would also hit commodities again and could hit the rand and would hit Nigeria. Short term, I'm worried about that. But going into 2021, if Trump loses the election, I think emerging markets are going to attract a lot more money in the next few years.
Okay, let me stick with South Africa a bit, since you've taken me to South Africa and we're looking at the rand, because you said if you want to come into the emerging market, you go for the South African rand. If you want to go out, you sell the South African rand. How will the economic recession that South Africa is suffering right now, and I must say 2 recessions in 2 years, how do you think it would also affect the currency, the rand? Bearing in mind also that economic rating of South Africa is not in the best terms right now. Credit rating, yes, down. So will that likely impact the South African rand too?
It will. So we have a model for currencies that tell us that the fair value for the rand is about 14 to the dollar. I'm arguing that it could go from around 17.5 today to 16.5 to the dollar, so a bit stronger by the end of the year. But I don't think it's going to go to 14. And I don't think it's going to go stronger than fair value. There are currencies that are stronger than fair value. Egypt, China, and quite a few others. But I don't think South Africa is going to go there because their economy is going to get hit very badly. They've already had 4 or 5 years of really weak growth. Per capita GDP, so the wealth of the country per person hasn't gone up in 5 years already. Similar to Nigeria, actually. And I don't think it's going to get better in the short term. So I don't think, the currency can rally because people like emerging markets. I don't think it's going to get strong because, sadly, South Africa's own problems will hold it back.
Emerging markets. The country weighing on emerging markets mostly is also China. Yes or no?
Absolutely.
Yes. So how would China also play out for African countries right now, African currencies, since China is a major player in the emerging markets? You understand what I mean, Charlie?
Well, I think Chinese lending to Africa is going to be less this year. And when the Chinese money has been coming into Africa, that's been supporting the currencies to some extent. So less money means, again, a bit more pressure on African currencies. The question at the moment is whether or not Chinese will accept a debt moratorium where they stop being paid interest on the loans that they've lent over the last few years. And it would make life a lot easier for a lot of governments if China said, you know what, we can take an interest payment holiday for maybe a year or so. And if that was to happen, that would help offset some of the pain that's going on this year.
Okay, let's come back home to Nigeria. Okay, come back home to Nigeria. I'm in Nigerian. If we take a look at the Naira, what is your outlook for the Naira? The Naira, the I and E window is doing 380. The Central Bank of Nigeria adjusted the currency just a few weeks ago in the middle of this pandemic. The MPC will meet tomorrow. What's your outlook for the Naira? What do you also think is the fair value of the Naira?
It's a complicated one because in the models that you use, it all depends on what time period you look at. So what is likely is if a country runs 10% inflation like Nigeria or even 12%, and if inflation is close to zero in America, then the currency has to sell off by 12% a year just to keep things stable. But that hasn't happened. So the Nigerian currency has not been allowed to depreciate in recent years to match the inflation rate that Nigeria has. So on our model, if you take a model back to 1995, when oil prices have averaged about $60, the fair value for the currency, our model says, is about 490 to the dollar. And we're at, what, 380 now, which is 27% strong to that. If you have a shorter dated model, and my colleague in South Africa, Yvonne Mahango, does, so we have two models at Renaissance Capital. So unfortunately, we have two different views on where fair value is. And her model says it's stronger at 410. And that model is been going since 2004. And oil prices since then have averaged $80. I think when oil prices are as low as this, the more conservative number is probably the right one. And that is what we're seeing in Angola. So the currency in Angola is cheap, as it should be according to the model. It's just Nigeria is still holding up very strong.
The argument for devaluation of the Naira has been in the public space for quite some time, that the central bank should leave the Naira alone. How much cogent reason is the CBN having right now to say, is managed float, according to what they call it? And if you take a look at the economy, our revenue is not diversified. We just depend on oil. We do not export other commodities like what China is doing. Of course, the allegations that China is manipulating its currency because it's an export nation and all of that. So what's your stance on that?
The argument in favor of keeping it strong is that Nigeria is still investing and importing investment equipment. For example, Dangote's new refinery. And the strong currency helps on that front. So I can understand that argument. And I also understand the view that Nigeria is not going to sell more oil if the naira gets cheaper. The price of oil is set in dollars, and it's unaffected by the naira. But what we've seen in East Asia, in China, or before that, Korea, and Korea, as you probably know, was poorer than Ghana in 1960. So they started at the same place. But what Ghana and China and Japan did was say, we were going to have a very cheap currency. So we'll stop buying imported clothes from somewhere else. We'll make our own because the currency's so weak, we can't really afford to import clothes. And that's how Japan in the 1920s and 30s built up a textile industry. It's how China then developed in the 70s and 80s after Korea had done this in the 60s and 70s. And I think the argument is that if Nigeria had a cheap currency, then people would buy Nigerian-made clothes instead of Chinese-made clothes. And it would create jobs in Nigeria. It would make Nigeria, give it an industrial base in time that could then be expanded. And once it's competitive and once it's making profits, then you can afford a stronger currency. So in the last 10 years, the Chinese currency has been getting stronger. And that, I think, is because they built up an industry on the back of a cheap currency. And when it was there and running, they then did their letting the currency strengthen and take advantage of their strength.
How do you think that Africa should deal with its vulnerabilities right now, since COVID-19 pandemic is hitting us? Because you're seeing that most African countries are going for loans from the IMF, from AFDB, from the World Bank. Are you satisfied with the way that we've been dealing with our economic vulnerabilities, bearing in mind also that some countries in Africa were not in a good position even before the pandemic?
It's going to take time. I mean, I've been really impressed by Africa's response to the virus. So when I was in Abuja in February, just a few months ago, and flying in and filling in my form and getting my temperature checked, and we're still not doing this in the UK. And the UK's got one of the highest rates of the virus in the world because of the UK's failure to act so well. So I think in that regard, Africa was quicker and better in its response than Europe. In terms of the economy, it takes time to adjust. I think getting cheap financing when it's available, and the IMF offer of 2.8 billion is cheap. That's a good idea. And I think there's been some good policy shifts. So formally removing the fuel subsidy in Nigeria was a sensible policy. Letting the currency go from 306, that official rate, to 360, 380 is also helpful because it gives the government more naira to play with from the oil price. So I think there's been some good policy choices made, but there still needs to be a lot more. I mean, longer term, it's issues like electricity, education, investment. Those are the big three needs for many countries in Sub-Sahara.
Yes, because I know you're always so big on those big three: investment, literacy, and electricity. I was also going to come to that in a bit on how Africa can achieve that even in the midst of this pandemic. Can it be achieved? Can investment be achieved? Just earlier, before you came in, I did say, talk about the report by the National Bureau of Statistics here in Nigeria. Foreign direct investment fell in the country in the first quarter of this year. So how do we achieve investment? How do we achieve that literacy level to be higher? How do we achieve the electricity you're talking about? Because most Africans still do not have electricity.
Okay, so there's a very long-term issue, which is demographics, that we've been looking at for the last year. When families have lots of children, they tend to have very low savings, and that's the case in Nigeria, Angola, Zambia, and when you've got very low savings, then capital becomes expensive, investment becomes expensive, and it becomes very difficult to sort out electricity sector if you haven't got money to build the infrastructure you need, the generation, the distribution, the transmission. So in the long term, governments need to try and encourage people to have less kids, because then you invest in your kids, you invest in their education, instead of having no money to invest in anything. That's certainly a priority. In the shorter term, given that takes a long time to change, what can you do? You can make yourself attractive to foreign direct investors. And that's what a lot of Asian countries did do. So welcome them in, give them tax breaks and so on, which is what Vietnam has done. It's improved a great deal in the last 10, 15 years. And the third thing you can do is to have a cheap currency. If you have a cheap currency, you have a current account surplus. You're exporting more than you're importing. Then you have a surplus of dollars or euros, whatever, floating around the country, and the cost of investment then goes down. And that current account surplus policy is what we saw in East Asia. Again, cheap currency gives you a current account surplus. It gives you more dollars in your country. That brings down the cost of investment. So that I think is where Angola has an advantage at the moment. They have a cheap currency that could help their current account and might then give them some cash to invest over the next 1, 2, 3 years. But sadly, Nigeria's got a current account, probably a deficit at the moment. So it's not in that position just yet.
Let me get your views about what you think the Nigerian MPC would do tomorrow. That's on Thursday. Of course, our CRR is at 27.5% right now. What do you think is the sensible thing to do that will make economic sense at this point? Raise, drop, or hold rates? Bearing in mind that inflation is high, in the brackets of 12%. Our GDP figures just also came out, 1.87% for first quarter. That's not too good at all for a country that is growing population rate of over 3%. So what do you think that Godwin Emefiele and his team will do?
Our assumption, and I always leave the really difficult questions for my colleague Yvonne Hango to forecast, and she's calling for flat interest rates. We think, given inflation is picking up and food prices are picking up, the central bank is going to veer on the side of caution, we think, and keep rates unchanged for now.
Okay. What do you think, or how do you think that Africa's recovery would look like? Will there be recovery soon? And what kind of recovery? What shape of recovery?
It's gonna vary from for example, drop from 6% to 3% this year, and in 2021 back up to 6%.
Oh, okay. Charlie, are you still there? I'm having a bit of difficulty hearing you.
Sorry, there's a connection problem here. But
yes, it's a connection problem.
We think that there's going to be a slow recovery in Nigeria.
Okay.
Recovery in Kenya, probably.
Okay. I think this should be my final question. In the midst of all this, how bullish are you for Africa in the midst of this pandemic? Are you bullish? If you are bullish, or are you bearish? Which countries are you bullish on? Which countries are you bearish on?
I think what happens in a crisis is that the countries that get hit the most recover the quickest, and the markets do best. That's America. And to some extent, that's going to then feed through into emerging markets next. And Africa hasn't been hit so hard yet. Is getting hit now, but it should be one of the last to recover. So it's easiest to be bullish on emerging markets today, because developed markets have done well. Emerging markets are just coming off the bottom. I suspect Africa will be next, maybe 3 months down the line. But we're already seeing the bonds do better, the Euro bonds do better.
Okay. What shape of recovery do you think? Let me ask that question again. What shape of recovery do you think will be for Africa? An L-shaped recovery, a V-shape, a U-shape, or W-shaped recovery, because of the analysis that perhaps a second wave of infections would invade the world. So what do you think? What shape of recovery?
We're not seeing any signs of a second wave anywhere in developed markets yet. So Denmark already started easing over a month ago, and the cases are just dropping and dropping and dropping. Same in Germany, and so it's a very good story for them at the moment. I'm not worried about the second wave much yet. We don't have any data to tell us to worry. But I think in Nigeria's case, the currency where it is, what this is telling us is it will be a quite a sluggish and not very exciting recovery. So a bit like after we saw in 2015-16. And that was quite slow growth. Countries that allow their currencies to move, like Russia, Kazakhstan, in 2015-16, they fell a lot, but then they rebounded fast. Nigeria chose not to have a slower currency adjustment, and that also means the recovery is much slower.
Great. Many thanks, Charlie, for speaking with me today. Hope to speak with you again sometime soon. Thank you very much. Have a wonderful day in London.
Thanks for having me on.
Yeah. All right, I've been speaking with Charlie Robertson, who is the Global Chief Economist at Ray Nielsen's Capital. We've been looking at Africa's economic response to the coronavirus pandemic. Let's quickly take a break. When we come back, Professor Uche Uwaleke, Professor of Capital Market and the former Commissioner of Finance, Imo State, will be joining me. We'll be looking at the MPC that will hold on Thursday, 28th of May. Is there still any bazooka left for the Monetary Policy Committee? He will be answering those questions when we return. Tomorrow. Any bazooka left?
Well, I don't see
What
much.
kind of chess game will be played tomorrow for people that play chess?
Yes, of course, against the backdrop of COVID-19, against the backdrop of supply disruptions, GDP drop, but more importantly, against the backdrop of rising inflation. So, for me, 4 things will influence what is likely to happen tomorrow. The first is the inflation rate, which is rising. Inflation rate at 2.34%, as of March. And that's even talking about the
12.34.
Yes, the composite figure. Because if you disaggregate that, the food inflation is where the problem is, at over 15%. So that will influence the decision tomorrow. The other thing too will be the exchange rate, the pressure on the forex. Okay, and of course you also have the issue of foreign investment. Yeah, you saw the numbers, recently, that the foreign investments into the country, even though it was 5.89 billion dollars, but it was less than what we had, corresponding in the period. And then there is also the issue of fiscal surprises, the government side. We still have an expansionary budget, at 10.5 trillion, okay, and with much of it, about 50% of that, going to be financed, through borrowing. So all this will really influence what will happen tomorrow. Previously, the choice has always been whether to increase, okay, or, to further tighten, because as it is now, the monetary policy is tight, with MPR rate at 13.5% and CRR ratio at 27.5. That's quite high, so it's already tight. So the choice tomorrow will exclude the issue of further tightening. So it will be between retaining and, cutting. And the arguments for retaining, at least much of the policy parameters, will be influenced more by these factors I've mentioned. Let's not forget that primarily the object of the central bank, as contained in the CBN Act of 2007, Section 2, makes it clear. It is to maintain price and monetary stability. You have other functions of the central bank, mentioned there. The other 4, issuing legal currency, maintaining external reserves, advisor to the government, and ensuring sound financial. But the major one is that stability. Yes, stability. And all the members of the MPC understand that. If you look at their personal statements, okay, that appears to be their mindset. That as far as inflation is concerned, that is the duty of the CBN, to rein in inflation. The aspect of stimulating growth is in the realm of the fiscal authorities. What the central bank can only do, is to support the government in stimulating growth. So by and large, it's going to be, I foresee them retaining the MPR at 13.5%, retaining liquidity ratio at 30%, the asymmetry corridor +2 -5. But the central bank may tinker with the cash reserve ratio of 27.5. I see them maybe returning to, I would advise, if I were a member, I would vote, that the previous level of 22.5 is returned.
Go back
yes, to free up, some funds for the banks. Remember, CRR is unremunerated. Whatever they put there is sterilized, by the central bank. So to free up a lot more funds, for them, given the fact that we have the loan to deposit ratio, okay, at 65, and we also have this high CRR. So it's already tight for them. And part of why, and there's COVID, and part of why it will not go down, I think the 13.5 may not go down again is because of inflation. Because once it drops below inflation, it means you now have a negative real return, which will discourage investors. Look at the numbers with the MBS released. Much of it, over 70% came from foreign portfolio investments. Yes, other investments about 21%, and then foreign direct investments, which is what we require, for capital formation to drive growth in this country, is mere 3% at less than $300 million. Okay, so we need to put all these factors into consideration. Inflation is very important. Why I say that? Because some people might argue recession, central bank needs to bring down the rate. But the central bank brings down the rate, for example, and there is liquidity surfeit. And that liquidity surfeit goes to now chase the scarce forex that we have. It will mount pressure again on our external reserves. Mind you, part of why we are having some accretion in external reserves is because of the loan we've just taken from the IMF, the $3.4 billion. Okay, that's why we're having this, accretion, in my view. And if the IMF is saying that they are giving you loan to help you fix your balance of payment challenges, it is not for you then to, do things that, will be seen to be undermining such efforts. So for me, taking that loan means we have swallowed a bone. Okay, we don't have any choice but to maintain the MPR rate at 13.5, such that it doesn't go below inflation. Nancy, there's also been this argument that across the world, many central banks are cutting rates. That is true.
Even across in
Ghana.
Africa.
Ghana, for example, but Ghana cut their own to 14.
Egypt cut, Kenya cut, South Africa cut.
Do you know why they're cutting?
Why are they cut?
Thank you. Ghana's inflation rate is 7.8%. So Ghana can afford to cut, and they even cut it as of March, 14.5%. So it's still well above the inflation rate. And the inflation band in Ghana is between 6 and 10%. In Nigeria, is between 6 and 9%. Okay. So why is South Africa cutting? South Africa cut because the inflation rate in South Africa is 4.1%. And South Africa just dropped their repo rate, their benchmark policy rate is repo rate, dropped it to about 5.2% or thereabouts. So they can afford to do so. In the US, it's nearly zero. Ranging between the Fed fund rate is between 0 to 5%. And that's because the average inflation rate there is 0.3%. Okay, so developed economies, these economies can afford to say they are doing bond buying, they are doing quantitative easing, they are pumping money into the place. Can we afford that, given where the exchange rate is?
So we can't afford that because our inflation rate is high and because our FX reserve.
The major problem I see there is even the exchange rate. Is the exchange rate. The CBN needs enough arsenal, enough reserves, to be able to, defend the exchange. Right now, yes, we have enough to cover some months of imports, okay? But given where oil price is, and given the forecast for, inflows of revenue, remember, 2020 budget is now being based on $25 per barrel. And we're also using 1.94 million barrels per day. As opposed to even what we had, the GDP growth that we saw at 1.87% is more because of the crude oil production of 2.006 million barrels per day. So it's higher. Now that we are using something lower, we may not get that level again. So
and
GDP
our
growth
volume would also drop to, I think, about 1.4 million barrels per day because
OPEC,
of the OPEC quota.
yes, OPEC cut. So
yeah.
when you take all these factors into consideration, you now begin to see that, yes, going into the subsequent quarters now, okay, even against the backdrop of IMF prediction or forecast that the economy will tank by 3.4%, you know, even below world average of 3%, okay, there is need to, you know, have an eye on, as I mentioned earlier, the forex market, because that is key. If you pump money into the place, for example, and all of it, you know, goes to chase a few dollars, what do you think will happen in an import-dependent economy? Exchange rate will go up, inflation rates will go, you know, skyrocket, and it doesn't mean anything if you have money in your pocket and you can't buy anything with it. Money is what money can buy. That's one definition of money. The power of purchasing power of money is very important. I have also read this argument that because of the COVID-19, because of the slowdown in economic activities, the velocity of money will drop. Velocity of money is the rate at which money changes hands. You know, back to simple monetary economics theory, the quantity theory of money. Ivan Fisher says if velocity of money is reduced, okay, that if you hold transactions constant and you hold money supply constant, price level will drop. So people have made that argument because of the slowdown in economic activities, lockdowns, velocity of money will reduce. And if it reduces, inflation will naturally drop. That has been the argument. There's also this argument that because of reduction in the fuel pump price, inflation will drop. But we haven't seen that happen.
Are we going to see that happen in the next few months?
It's not going to happen.
What's your outlook for inflation, especially like for April? Of course, March 12.34%. For April now, for May, what's your outlook moving forward? Yes,
my outlook, remember, well, theory says that...
Because the lockdowns really happened in March and April.
Yes. Now, part of why we're having this increase in general price level is, of course, you know, the border closure is still there, okay? Supply chain, so you have increase in cost of, you know, production. But again, you know, if you look at the figure released by NBS, the problem really is not with the core inflation. Core inflation is still below 10%. It's around 9.9%. It's still below 10. Okay, and even though theory says that monetary policy should not base decisions on the food component, because the food component is seasonal. Okay, the challenge we have seen in this country is that the food component has persisted. It has been, you know, quite on the high side, and the last figure we have is above 15%, and this trend is likely to continue, except something again is done about food. Okay, except we can have enough supply now to match the demand, you know, for food. So, and that is why the central bank has to now see how it's already doing that. Okay, as part of its development finance functions, it doesn't really have to be true. Monetary policy tools are limited, really. You're talking of the MPR, you're talking of the liquidity ratio, it's really, you know, limited. So, and that's why the central bank sometimes goes out of the box, heterodox measures as part of its development finance functions to stimulate growth. That explains why you have all these interventions. So it's for the central bank to scale them up. The Anchor Barrel program has been a success story. Okay, so it's now to scale it up, accommodate more products, and expand it to a greater number of states of the federation. Okay. Now the other interventions in agriculture, the accelerated agricultural development, again from experience, I know, yes, they are all there. So it's for the central bank to really focus, and these intervention funds that are already out. Okay, central bank has apart from the 50 billion that they're using,
microfinance bank.
Yes, through the NASA microfinance bank. There is also another 1 trillion for, you know, manufacturing and exactly, and 100 billion for the health sector. So all those funds, okay, should be well targeted, targeting health, targeting agriculture in particular, and of course manufacturing. So when we target agriculture and produce food, okay, food inflation will come down, and once it begins to come down, the central bank can now be in a comfort position to say, okay, let's now drop the MPR. From 13.5%. There's another thing too we have to consider from experience. Studies have even shown that whenever you increase the MPR rate, banks are invited to increase lending rates. Automatically, they increase their lending rates.
Yes.
Okay, when you increase MPR. And that also tends to worsen the asset quality of banks, because you tend to have increase in non-performing loans. Okay, you have a lot of defaults, in payment. But on the other hand, when you drop MPR, you would also expect that banks should also reduce, but that doesn't happen. Okay.
Yeah, from experience.
Yes, it doesn't happen. So interest rates really in our economy, interest rate is sticky downwards, and you know why?
So that means
because of
the MPR is not having as much effect as it should have, like we see in other countries.
Yes, and that's partly because of the weak transmission, mechanism that we'll find, and also embedded in the structural bottlenecks that we have in the economy. For example, if you reduce MPR and you have not fixed power, for example, okay, the banks are having issues with power insecurity and so on. Okay, you still have not solved the problem, because if a bank is running on generator, it's also increasing cost, and that cost somehow is passed on to the consumers. So by and large, while the argument to reduce appears attractive, appears persuasive, okay, the balance of risks, in my view, will be to still, have a rein in inflation, because for me, that is, critical. Some might say we should opt for growth. Yes, growth is very important in this period, but the fiscal authorities should also complement. If we remember the 2020 budget, 10.5 trillion, we were expecting that the budget to be slashed by as much as 1.5 trillion. If you read the MPC communique of March, the MPC was even lauding the federal government for reducing it by 1.5 billion, in line with realities, but that didn't happen. Maybe the federal government now felt, it could get money here and there, okay, and then just slashed it by 71 billion. So there will be much money again you have in the system, which the central bank will have to manage, will have to control, okay. And the U.S. Federal Reserve has a dual mandate. If you look at the first mandate there, it is maximum sustainable employment, okay. Second one is stable prices, and then you have moderate long-run interest rates. So that is for the U.S. Some other central banks, they have dual mandate, but our own central bank, CBN, except it's amended, Section 2, it is very clear. Price stability and monetary stability. So that is the focus, and as I said, all of them understand that. You have the central bank governor, you have 4 deputy governors from the central bank, you have 2 directors again from the central bank, you have 2 other people appointed by the central bank. So that leaves you with just 3 people from outside by the president. So the insiders, so to say, understand this, and that is why in future we should expect that should drive the decisions of the MPC. Okay,
so where do you stand? Hold, raise, reduce?
Yes, as I have said, we hold. Tinkering with the CRR, yes.
Lower?
Yes, we lower the CRR to free of funds. Remember, not too long ago, the central bank had to sanction some banks, for not meeting up with their CRR requirements. Yes, and the central bank has said no bank should lay off staff. No bank should do this. So,
I don't know if they are listening to that.
No, it's the banks. We are part of the agreement. Now,
yes, the bankers committee. I don't know if they adhered to that.
So the CBN should have something, for them, as an incentive not to do that. That's why I'm thinking they should drop CRR. Ghana also dropped their CRR from 10 to 8.5%. Yes.
Okay. Thank you very much, Professor Uwaleke, for shedding your own perspective on this issue. Let's see what the MPC will do tomorrow. We expect perhaps it's going to be virtual because the world has gone now on an accelerated level. We've been all forced to adapt a new normality. So thank you very much, Professor Uwaleke.